A very warm welcome to all of you. Uh, this is going to be a knowledge sharing session on Ind AS. We will try to cover quite a few Ind AS over next few days. So for today's session, I have selected a standard, which is a very simple standard, Ind AS2 on accounting for inventory. Since it's going to be the first session, so I thought I will select a standard, which is fairly simple, easy to understand for all, so that we understand the basics of the standard. Now, today, I will broadly cover into three aspects of the standard. The general expectation out of this session is majority of us understand the standard, so I am not going to spend a good amount of time in terms of explaining the nitty-gritties of the standard. So I will have a very quick summary of the standard. We will try to spend some amount of time to understand few critical points about the standard. Then we will spend the last segment about this session on what are the things or items that has to be considered by the accounting group or the finance accountants post COVID 2019. We will try to spend some amount of time over there. We will try to make as crisp as possible so that we spend very little amount of time to effectively utilize to understand the standard as a whole. Now, as most of us, we know the objective of the standard is the objectives of the standard is primarily for the account of the cost which has to be recognized as an asset and its subsequent recognition as an expenses, including any write down, if any. This standard is applicable to all types of inventories bearing two items, financial instruments, because it is covered under Ind AS 32, which is financial instrument presentations, and Ind AS 109. Biological assets related to agricultural activity and produced at the point of harvest, because it is covered in Ind AS 41. Now, all of us, we know the definitions. This standard talks about definition of three items, which are being used in multiple paragraphs in this standard. One is obviously the inventory. And most of us, we know inventories are assets which are held for sale in ordinary course of business, in the process of production of such sales, or in the form of materials or supplies to be consumed in the production process or in the rendering of service. Quick example. Now, let's say a company who is into food and beverages industry, if they are purchasing a vehicle which has to carry their inventory from one place to other place, that vehicle cannot be considered in their business because that is obviously not in their ordinary course of business for the sale. However, the same vehicle for a vehicle manufacturer like Mahindra or Tata or Ashok Leyland will be considered as an inventory because that is their nature of business. So that's broadly the difference, what we mean by asset held for sale in ordinary course of business. The next definition, it talks about net realizable value. It's nothing but the estimated selling price. Again, to be underlined, the ordinary course of the business, and it has to be reduced by if there has to be an estimated cost to complete that inventory to make it available for sales, or we are spending an estimated cost which is necessary to make that inventory sold. If we are incurring any of those costs, that has to be reduced from the estimated selling price. There is another definition which talks about fair valuation of the inventory. That is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants. We will spend some time to understand is there any difference between fair value and net realizable value after this session. Now, fair value, as all of us know, there is a separate accounting standard, Ind AS 113, which deals in detail about how exactly the fair valuation of an inventory or fair valuation has to be identified. Moving on, as we know, this inventory, when it says, the whole crux of this standard is how the inventory has to be measured or valued. The general principle for the valuation of the inventory is it has to be measured at the lower of cost or net realizable value. Whatever is lower out of these two parameters, that should be the value of the inventory. We understood what is net realizable value in the previous slide. So now let us understand what is cost. Now, cost here is an inclusive definition. It's not being exhaustively defined, same as the net realizable value. It's an inclusive definition. It's very subjective. However, we will try to put it together to understand what cost means. So broadly, it includes three components. One is the purchase cost. If anything that we are buying, anything that we are paying to a vendor for purchasing the goods, that obviously it has to include. If we are importing something, or if during the payment of any of those goods, I pay some tax, which is not recoverable from the tax authorities, that also has to be included as part of the cost. For example, when we import the goods out of India, we pay basic custom duty. On top of that, we pay IGST. Now, IGST is generally being recoverable from the tax authorities. So that is why that component of tax is not included as part of the inventory. However, the basic custom duty, which we pay, that's generally not recoverable from the taxing authority. So that is why the basic custom duty should be part of the inventory. Then if we are incurring any transportation or other related costs to bring the inventory to our premises where the manufacturing happens, so that is also part of the cost. Any cost that is directly I can attribute to that particular inventory, that will be part of my cost. If we are getting anything on trade discount or rebates or anything that sort we are getting while buying this inventory, that has to be reduced out of my cost. Once we receive the material inside my factory premises, the next important factor is converting that purchased material to the sellable goods. So that is why the next thing comes as the conversion cost. So broadly, when we convert the material, there are two kinds of costs that we incur. From a cost accounting perspective, we all would able to relate it. One is the fixed overhead. Second is the variable overhead. As all of us we know, fixed overhead is irrespective of my level of production. This cost is going to be constant. Variable overhead normally goes up or comes down depending on my level of production. So this standard talks about in detail about how exactly we are going to handle, but to summarize at a very high level, fixed production overhead has to be apportioned to the inventory only at the normal capacity level. We cannot increase the cost of inventory or reduce the cost of inventory depending on how the plant is being utilized or how the plant is moving in terms of the demand and supply situation. Variable overhead, again, it's a direct apportion to the production because the cost movement that exactly happens in terms of a production. Apart from these two important costs, if there is any other cost that we require to bring the inventory to the present location and the condition, it's again a very, very thin line. We have to be careful which cost to be included, which cost not to be included. That's very, very important factor. If anything that we think that's required to bring the inventory to present location and conditions, that cost also should be part of the inventory cost. Example, for example, let's say storage cost. Now, you require a portion of storage when your inventory moves from one line to other line inside your shop floor. Now, if you're incurring a specific cost for that kind of storage, that cost also should be included as part of the inventory. That's very, very important. Now, there are certain segment of cost which not to be included, that's being specifically defined. For example, abnormal cost, like if you have a standard scrap which happens as part of your manufacturing process, that's a normal scrap, which obviously you can include as part of your inventory. But if there is a scrap which is happening because of you have introduced a new part, because of some of the technical glitches that you have inside your factory, so those kind of scrap is an abnormal scrap, is an one-off scrap. So that should not be part of your inventory. Now, storage cost we discussed about. If there is a storage cost for storing of your finished goods inventory, that should not be part of your inventory cost. And any cost that you incur once the goods is ready to sell it in the market till the time it's being sold to the end customer, any cost that you incur during this period is not part of your inventory cost. Those are purely selling and administrative cost. Moving on, the cost formula. Now, broadly, if you look at this inventory, you can divide this inventory into two components. One, there are inventories which is not ordinarily interchangeable, which means those are primarily project specific. So for example, if you're manufacturing anything, let's say the gearbox of a particular item. Now, these gearboxes, these are not ordinarily interchangeable. These are all project specific gearboxes which are being customized for a particular application. Now, when you have inventory to that kind of nature, the cost has to be specific to that project or specific to that inventory. You cannot interchange the cost of that particular inventory to the cost of other similar inventories that you are producing inside your factory. Now, on the other side, you will have inventories which are interchangeable or which doesn't fall under this category. So now this standard talks about two things. One, it is project specific, which are not ordinarily interchangeable. You can very well put the individual cost for that inventory. Now for the other categories, the standard gives an option. Either you can follow first in, first out method or weighted average method. You can choose depending on your industry, depending on your nature of your business. But once you choose a particular method, particular cost formula to be applied, that has to be applied for the similar nature of inventory. You cannot interchange. For few materials, you will be kind of apply FIFO, few materials on weighted average. That's not allowed by the standard. For the similar nature of inventory, you have to take one cost formula. There are multiple techniques which is also being given by the standard. The company can choose whether to follow a standard cost method that's being allowed or a retail method. Standard cost method is basically being adapting to standard cost, where you define a cost at your normal level of production, labor efficiencies and capacity utilization. Then on a quarterly or monthly basis, depending on your reporting standards, you actualize that cost. Retail method on the other side is specifically being used in the retail industry, where inventories are being measured in large numbers. There is a rapidly changing environment in that particular segment. So cost of inventory is basically being determined in that industry by reducing the sales value of the inventory by appropriate percentage of the gross margin. Now, majority of the manufacturing industries, which doesn't fall under retail, they broadly follow the standard cost method. Now, coming to this expense recognition. Now, all of us, we are aware of the concept of matching concept. Now, the general accounting principle talks about the concept of matching concept. So which effectively means whenever I recognize a revenue, there has to be a corresponding cost. I cannot recognize revenue in one period, expense related to that revenue in a different period. So that's the broad guidelines we all have been brought up to. Now, similarly in inventory, when inventories are being sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the revenue is recognized. That's a broad principle. There is nothing new as far as this standard is concerned. Now, what's more important is if there is a writing down of the inventory. Now we discussed about the inventories has to be accounted the lower of cost or net realizable value. If your net realizable value is lower of that of cost, obviously you have to write down the inventory to the tune of net realizable value. So that means you have to account a loss. Now this loss or the write down value has to be accounted in the period when it is incurred. Okay. So broadly in India or anywhere, depending on the reporting, most of the listed companies, they report once in a quarter. So basically this exercise is being done once in a quarter. So where we identify what is my net realizable value at the material level for each of those items and what's my cost if there is a gap, and that's on account of loss. So we basically account that loss. Whenever inventory is allocated to another assets, there is a possibility. You think of a situation of a construction company and let's say a cement company. Now they are under both groups. Now, if an inventory which is being issued as a component to the self-constructed property, at that point in time, it has to be accounted over the useful life of that asset. Okay, it's not because there is no revenue. It's been going from one unit to other unit. It's a subproduct which is being used in another site. So in that case, this expense of this inventory, what I am using it will become part of the self-constructed property inventory. So that has to be recognized as an expense over the useful life of the asset. Now coming to the last part of this standard, which is the disclosure, which is very, very critical. We discussed about the accounting policies, the measure of inventory, including the cost formula, whatever the company is opting for, that has to be defined over there. Classification of the inventory, which is required, whether it is finished goods or work in progress or semi-finished goods or raw material, that has to be given over there. Obviously, the carrying amount, which has to be given. Now, inventory, wherever it is recognized as an expense, whenever you recognize as a revenue, plus write down of loss, that has to be recognized. If you are reversing this write down in a subsequent period, you have to also give in your notes of accounts, in your disclosure, what is that circumstances based on which you are reversing the write down inventory. Then if your inventory has been placed as in security for the liabilities, there is a specific disclosure requirement which has to be disclosed. Now this broadly covers at a very high level what this standard talks about in terms of the definition, in terms of the measurement, in terms of the accounting, and finally the disclosure. Now let's talk about few of the critical items, what probably is not covered in the standard, or what probably being various issues which is being discussed over a period of time. The first one, just to give you a quick update about the difference between Ind AS and International Accounting Standard on this particular subject. You would have seen the paragraph 38, which talks about in Ind AS in terms of the functional reporting of this inventory is being deleted in Ind AS2. That's primarily because of two things. Now the expenses can be reported as function wise or nature wise. So when I say function wise, take an example of manufacturing expense, the selling and administrative expense, the packaging warehousing cost expense. So these are all function wise expense, the expense which are being taken as that particular function. Now, what do we mean by nature wise expense? Like employee expense, the staff welfare expense, the packaging cost, the printing and stationery expense. These are being called as nature wise expense. Now, this is a difference where International Accounting Standard 2 and inventory that talks about or that gives an option. Either you can follow function wise or nature wise. That gives an option in International Accounting Standard 2, which talks about presentation. So that is why there is a paragraph of 38 in Ind AS, in International Accounting Standard 2. However, in Indian Accounting Standard, the Ind AS 1 talks about only present the nature wise expense. So that is why this paragraph 38 is not relevant as in the Indian context. So that's why you see it's being deleted from our standard. Now let's talk about few critical points. Abnormal cost. How do we consider it's part of the inventory cost? We discussed about in detail about why abnormal cost should not be part of my inventory cost, because abnormal is abnormal. It's very, very important to understand what abnormal is. And again, that differs from industry to industry, company to company, situation to situation. So it's extremely critical for the finance folks to understand what exactly the abnormal cost means and how do we define and document the abnormal cost is not part of the inventory cost. Second is packing cost. Now, this is a very, very interesting topic. Packaging cost broadly being divided into two components: primary packaging, secondary packaging. Okay. Let us take an example. For industry like food and beverage, now the item like or packaging item like bottle or can, these are all primary. You need to have this kind of inventory. You need to have that kind of packaging to hold that inventory. Without that, you cannot hold the inventory. So these are being called as primary packaging because that's must. So in this kind of industries, when the packaging is primary in nature, that cost is part of the inventory cost. But if the packaging is not primary in nature, it's a secondary packaging, which you require to sell it in the market, that cost is not part of the inventory cost. Same thing, if I take the same example, the can for a food and beverage industry will be a primary package, which has to be part of the inventory cost. Now, when I put that can in a cotton box, where I put few cans in a cotton box and make that a sellable box in the market, the expense that I incur for the cotton box is a secondary packaging. So that's not part of the inventory cost. Now, expected selling price, again, it's a very, very interesting topic. It again differs with the situation, differs with the things, though the definition is fairly simple. It is the net realizable value which an entity is estimating to receive it. So what is critical at that point in time is how do I arrive at that value? Normally, companies that take the average selling price for a year or the latest selling price, whatever data is available. Again, it's being done with multiple iterations with a multiple information data point that's coming from the respective thing. So the whole objective is whatever number we put it over there, that has to have some relevance in kind of evidencing our fact that that is the price where I can get it for the company when I sell that product in the market. Treatment of fixed overhead, we discussed about. Fixed overhead is basically an overhead which remains fixed irrespective of your production level, like for your employee cost, like for your depreciation, your insurance and taxes that you pay. You do certain portion of the building, you do certain minimum power cost for a particular factory, so on and so forth. Now, what's more important is when we apportion this fixed cost is basically being apportioned with the normal capacity level of the particular unit. So it's very important to take care of certain adjustments whenever it is required when the plant or the manufacturing unit is extensively underutilized or overutilized. So we need to very well understand what are the costs to be considered, what are the costs not to be considered. The standard deals in detail about various scenarios, how exactly the cost has to be considered over there. Now, the next point is important. There may be a situation where we may buy from a particular vendor in terms of an extended credit terms. Okay, so in a regular market, you get that product in a 30 days term. A particular vendor of you is giving you 60 days term. So now this 30 days of extra credit that you are getting, there is a cost involved with that, obviously. Now that cost, it's very, very important to identify that cost because that cost is purely your financial cost. You should not include that kind of cost in part of your inventory. That has to be financial expense or interest expense. So that cost has to be separated whenever we incur this kind of additional cost because of the industry, because of the separate practices that we follow. That's very important to identify that cost and separate it from your inventory cost. Now, distribution warehousing cost, as we know, once the production is over, any cost that I incur from the time the goods are ready for sale till the time it goes to the end customer, any cost that I incur in between, it has to be part of my selling and administrative cost or other distribution cost. This is not part of the inventory cost. So these are a few critical points I thought probably apart from the inventory standard, which has to be covered, and we need to understand the concepts behind each of those items. Now let us go to a few of the important aspects that we understand. We discussed about the definition of net realizable value and fair value. So now let us understand, is there a difference between NRV, which is net realizable value, and the fair value? Now, prima facie, if you look at the definition or the wordings, now most of us, we understand both are same, because at the end of the day, I'm selling a product, I'm getting a price for it. So both are same. Now there is a difference. Now, if I go to the definition in detail, if you dissect the definition in detail, NRV talks about it's an estimated selling price in an ordinary course of the business. And from there, if I have to incur any cost to sell that product in the market, I have to reduce it. Now, on the other side, the fair market value talks about it's a price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, if you clearly look at these two definitions, though broadly they talk about it's a price based on which I'm exchanging a product. Now, the difference between NRV and fair market value is in twofold. Fair market value, if you look at it, it's always market driven. NRV is always entity specific. So that is the biggest difference between these two definitions. Now let me give an example so that we understand this concept clearly. Now let's say you sell a product, and that product in a market, you can sell it at rupees 10. Now for the same product, you have an open order from one of your customer, and the order price you got is 11 rupees. Now, when we do the inventory valuation, for us, the net realizable value is 11 rupees and the fair market value is 10 rupees. So that's the difference between NRV and fair market value. Now let's go to the next important aspects. Now, how do I disclose? And this is what many companies, if you look at the annual report, probably they don't disclose it in a rightful manner, which standard expects and which has come as a frequently asked questions by the Institute of Chartered Accountants of India. Now, when we reverse a write down of inventory, like when we do a comparison or measurement of your inventory, which is lower of cost and net realizable value, and you write down that inventory, let's say in a subsequent period, again, the net realizable value has gone up. So you have to reverse the write down. When you reverse the write down of the inventory, you have to disclose that separately from a numbers perspective on one side. Second, on what circumstances you are reversing it, why that circumstances are arising. So now in a general inventory from a balance sheet perspective, you will classify with this kind of classification: raw material, product in process, finished goods. From an expense standpoint, it's very, very important to understand this expense standpoint. It's very important to understand. So you report that reversal as a separate line item over here. Okay. So you report that reversal as a separate line item. That's very important to understand. Now let me go to the next point, machine spares. Now this machine spares is, earlier it used to be kind of reported as part of the accounting standard 2, but Ind AS it's not specifically being mentioned. That's primarily because it's covered in Ind AS 16. If the machine spares satisfies the definition of asset, tangible assets, as per the criteria which is being defined in Ind AS 16, that has to be capitalized. If it is not following that particular standard, or it's not satisfying one of these conditions, that will come back to inventory. So that is how it is being taken care of, and that's how it's being addressed. Now let's come to the last segment about this session. post COVID 2019, what are the areas that we need to look into as far as this standard is concerned as a company and obviously from an audit perspective? The first thing what we need to look into is the deferment of the vendors, payment to the vendors. Now we talked about paragraph 18 about of this standard talks about, now if we are paying the vendor some additional, we are getting some additional credit than the ordinary course of business. Obviously, we need to identify the cost for the inventory and the financial cost element that's being included as part of that cost that has to be separated. Now, in this situation, once we are back to the normal mode of business, at least for next few months, it's going to be an era where we will talk about a lot of negotiation will happen in terms of the deferment of the payment, specifically in the material side or the extension of the credit term. Now, we need to clearly, again, it differs. There is no yes or no answer for this. We need to clearly assess the situation and we need to see what are the areas that has to be looked into. But that's an area which talks about if there is a deferment and if it is different from the normal course of business, obviously we need to find out the finance cost element in that particular cost and we have to take it out and we have to value it accordingly. So that's one area which has to be looked into. The second point. Now the fixed overhead we talks about, normally it gets spread across the normal volume of the unit. Now given the situation, there are many units which are under lockdown, many units which are being closed for a substantial period of time. So the definition of normal volume is a question mark. So what's more important is we need to identify the fixed overhead and we need to see that we do not overburden the inventory by loading that to the inventory, which effectively means specifically the cost related to this period where it is underutilized to be charged to expenses. Again, it differs from case to case, industry to industry, companies to company. This has to be specifically assessed and appropriate call has to be taken in this area. The next important point comes to the net realizable value. Now, selling price given the market condition, which clearly fluctuate with your demand and supply categories. And again, it differs from industry to industry. It's an area which has to be looked into. What should be my NRV? Now, the companies which blindly follows with certain average selling price over last few months or few years or several years has to be very careful in terms of their understanding, whether any specific things which has to be addressed while calculating the net realizable value in this particular period. That's very important one. We also need to assess if there is any additional cost that may come because of the disruption, which may have an impact. So that has to be assessed, that has to be looked into. And finally, if there is any other items which are specific industry like there may be cases like obsolescence, there may be cases like aging of inventory, which we are not going to sell in the near future, which may again tantamount to obsolescence. We may have, a lot of companies may have due to lockdown in the transit inventory, which obviously, if these are perishable goods, if these are goods which cannot be used over a certain period of time. So those kind of items which has to be kind of keep it in mind while doing the inventory valuation as far as this year is concerned. So broadly, I thought I could able to summarize very quickly on these items as far as the standard is concerned. We will try to cover all other standards in the similar fashion over next few days, and we will see how best we're able to accommodate in that. So till then, take care, stay safe, bye.